The auction yard outside of Harlan County smelled like diesel and cold coffee, and the particular kind of silence that falls when men are watching something they don't want to believe. It was March 1982, a Tuesday, early enough that frost still sat on the hoods of the pickup trucks. Maybe 60 people had gathered, and not because the bank had called them. Nobody had called them. Ray Decker had called them. That was the part nobody could get past. Ray Decker, who farmed 880 acres of corn ground south of the county road, who had a John Deere 8430 that still had the factory smell in the cab, who had built his equipment line over 15 years into something that other men pointed at and said, "That's what success looks like." Ray Decker had picked up the phone and dialed the auction company himself. He was selling the 8430, the 4430, the 16-foot chisel plow, the 24-foot field cultivator, the grain cart that could hold 700 bushels. He was liquidating roughly 60% of his line on a Tuesday morning in March, and the combine wasn't even in the yard. He'd already cut a separate deal on that. Not because the bank made him, because he decided to. The word had spread the night before. By morning, the coffee shop in town had processed the information the way small communities always do, with 3 competing theories. First theory: Ray had lost the place and hadn't told anyone yet. Second theory: Ray was sick. Third theory, advanced by the men who had known Ray since high school, who understood that he was methodical in a way that made some people uncomfortable. Ray had figured something out that the rest of them hadn't. Most people went with one of the first 2. Here's what you need to understand about 1982, because without it, none of what follows makes any sense. Interest rates going into that year were sitting near 20%. The prime rate had been at 21%, 5% in June of 1981. Farms that had borrowed to expand through the 70s, and almost every farm had borrowed to expand through the 70s, because the USDA and every ag lender in the country was telling farmers to get big or get out. Those farms were now carrying debt service that had been calculated on a 9% world and was now living in a 19% world. The payments hadn't changed. The math had. Grain prices weren't cooperating either. The commodity price run of the 1970s, the one that had convinced farmers across the Midwest to double their land base and triple their equipment lines on credit, had flattened. The Soviet grain embargo hadn't helped. Corn was running $2, $40 to $2, $60 when the loans that financed all this expansion had been underwritten on 3.000 projections. The margin wasn't there. But most farmers looked at that and said, temporary, market cycle. Hold on. Ray Decker had been looking at something else. He'd been looking at dealer lots, not buying, looking. Through 1981, he'd noticed that John Deere and Case dealer lots were filling up with used equipment, not distressed iron, not junk, good machines, current models, coming back through trade-ins at a pace that was quietly unusual. He'd been to 2 county auctions in the fall of 1981 that had drawn 3 times the normal crowd of bidders. He'd watched a 4440 sell for $4,200 less than book. He didn't say anything about it. He just drove home and sat at the kitchen table and started doing math on a legal pad. Fixed costs are inflexible. That was Ray's starting point. Equipment loans don't adjust to the price of corn. Insurance doesn't care what the market is doing. When you own $380,000 worth of machinery, you own $380,000 worth of machinery, whether corn is $3 or $2. $0. The machinery requires maintenance. It requires insurance. It requires loan payments. And here's the part that the optimists never want to work through. If commodity prices drop 20%, your fixed costs don't drop 20%. They stay exactly where they are, which means your variable margin has to absorb the entire swing. Debt doesn't shrink. The other thing Ray had been watching was his own operation. He had 880 acres, most of it rented. The owned ground was 320 acres, his father's place plus one 80-acre parcel he'd purchased in 1978. The rest was cash rent. He had the equipment to farm 1,400 acres efficiently, which meant that on 880 acres he was carrying significant overcapacity. Every farmer carries some overcapacity because you need redundancy at planting and harvest. But Ray had been honest with himself. He had too much iron for what he actually farmed, and every piece of that iron was costing him money every single month, whether it turned a wheel or not. He'd spent the winter running numbers, not hoping, not projecting optimistic commodity prices, running actual numbers, current debt service, current operating costs, current land rents against current corn prices. The spread was thin enough that a bad year or a further price drop would push him into a position where he was making payments out of principal, which meant eventually he wouldn't be making payments at all. So on a Tuesday in March, Ray Decker drove to his own auction and watched 60 of his neighbors try to figure out what was wrong with him. A neighbor named Dale Westerfield, who farmed 1,200 acres 4 miles west and had done his own share of expanding through the 70s, leaned against a fence post near the 8430 and made the assessment that would follow Ray for the next 18 months. "He's done," Dale said to the man standing next to him. "Either the bank is forcing his hand and he's too proud to say so, or he's making the worst decision I've ever seen a farmer make. Either way, he's done." Ray stood 40 feet away and heard it clearly. He kept his expression flat. He didn't walk over and explain himself, didn't offer the legal pad with the numbers, didn't defend anything. Just watched the auctioneer work and let the process go where it went. The 8430 brought $41,000. The 4430 brought $29,500. The implements moved slower. There was already softness in the smaller iron. But everything sold. At the end of the morning, Ray had converted roughly $118,000 of equipment into cash. After paying off the equipment loans attached to those machines, he cleared $63,000 in free liquidity. He drove home, put the check in the safe, and started figuring out how to farm 880 acres with 40% less equipment. The answer was simpler than it sounds. He still had his planter, his sprayer, his grain cart, and a single tractor. For the work the sold equipment had done, he made arrangements with 2 custom operators and 1 equipment sharing agreement with a retired farmer 6 miles north who still had a working chisel plow, but no longer wanted to run it himself. The custom work would cost him, but it would cost him variably, only when the acres needed it, rather than as a fixed monthly loan payment, regardless of what was happening in the field. It wasn't the same as owning everything outright. Ray knew that. He lost some flexibility, some speed at planting windows, but he'd traded inflexibility in his cost structure for flexibility in his cash position. And in the spring of 1982, cash was the thing you needed, or so he thought. The spring of 1982 was about to test that conviction in ways he hadn't fully anticipated. The corn came in that fall around $2, $50. Not disaster, but nothing to celebrate. Ray made his land payments, paid his operating note, and put $14,000 back into the operating account. The farm was intact. He hadn't expanded, hadn't gained ground, but he was carrying less debt than he'd had in 5 years. Meanwhile, Dale Westerfield had a different kind of fall. He'd bought additional rented acres in the spring. 160 acres opened up when an older farmer in the county decided not to plant, and had negotiated the cash rent on a projection that corn would be closer to $3, water by harvest. It wasn't. The 160 additional acres had cost him more to plant and harvest than they'd returned. Not catastrophically, but the margin that should have justified the expansion simply wasn't there. Dale didn't talk about it. He was still out there every morning, his operation looking exactly like it always had. From the road, nothing had changed. New pickup in the driveway. same row of equipment in the shed. From the road, Ray Decker looked like he'd been gutted. That's the thing about agricultural communities and the way they read success. The equipment line in the yard is the scoreboard. The truck is the signal. Nobody sees the operating note, the variable rate credit line, the cash rent obligations that lock you in regardless of price. Ray's yard looked smaller. Dale's yard looked exactly the same. The coffee shop consensus was clear. Dale was managing the downturn. Ray had cracked under it, and then grain prices briefly recovered. In early 1983, corn futures pushed back toward $3, 10 on speculation about reduced acreage and export demand. The recovery was partial, short, and built on assumptions that hadn't been confirmed, but it was enough to feel real. Farmers who'd been grinding through 1982 exhaled. The optimists, who had been saying temporary all along, felt like the evidence was arriving to confirm them. Ray felt something he hadn't expected: doubt. He'd sold $118,000 of equipment at March 1982 prices. If grain had genuinely recovered and the cycle had turned, he'd made an expensive mistake. The machines he'd sold for $41,000 and $2,900 were still out there. The man who'd bought the 8430 had it out in the field. The equipment was still working, still generating revenue, just not for Ray. He sat with that for a few weeks in early 1983 and didn't say much. But he kept doing the math. And the math said that one spring of recovered futures wasn't the same as a structural change in interest rates or land debt levels. The farms that had borrowed hard were still borrowed hard. The debt hadn't changed. The variable rate interest hadn't changed. And the commodity price that was now trading at $3.10 had been built on acreage projections that the USDA would revise downward by summer. Liquidity decides, not price, not hope. Liquidity decides who gets to keep making decisions. Ray stayed where he was. The summer of 1983 confirmed what the math had been saying. The first repo that anybody in the county actually saw. The first one where the bank truck pulled into a neighbor's lane and the equipment came out. Happened in July on a farm 6 miles east. The farmer's name was Harold Prentice, 54 years old, had been farming since he was 19. He'd borrowed against his equipment line in 1980 to make a land purchase that had seemed conservative at the time. 2 years of tight margins later, he'd burned through his operating reserves and was 90 days behind on the equipment note. The bank sent 2 men and a lowboy trailer. Harold's wife called 3 people in town before the trailer had cleared the driveway. By afternoon, the whole county knew, and the conversation in the coffee shop had a different texture now. The word temporary appeared less. The word adjustment appeared more. Older farmers who'd seen the 1950s farm pressures started saying things in measured tones that the younger farmers didn't want to hear. Dale Westerfield didn't say much that week. He'd passed Harold's farm on the way to town and seen the empty lane where the combine used to sit. Equipment prices started moving in September. Not dramatically, 8 to 10% off the late 1982 levels, but directionally clear. Dealer lots that had been full in the fall of 1981 were now overflowing. New equipment was sitting unsold. Used equipment that came in through trade was being priced down to move and still not moving. The auction yard that Ray had walked through in March 1982 was running sales twice a month instead of twice a year. Ray watched all of it and kept his checkbook in his pocket. The second visible repo in the county happened in November. A younger farmer, mid-30s, had gotten aggressive on a land purchase in 1979 using a variable rate loan at an institution that was now calling the note. The land went to auction. It sold for 22% below what he'd paid for it 3 years earlier. The county's understanding of what was happening shifted in a way that coffee shop optimism could no longer paper over. This wasn't a cycle. This was a structural correction. and it was moving at a pace that was going to catch anyone who was standing still holding debt. Ray called the auction house in December, not to sell, to ask what equipment was trading for. The 1984 auction season was something that the Midwest farm crisis would eventually be counted by. In machine counts, in farms lost, in families displaced. But in the middle of it, what it looked like at the county level was a dealer lot in February with 40 pieces of used iron sitting in rows and a price list that had been marked down 3 times since October. The John Deere 8430 that Ray had sold in March 1982 for $41,000, he found one in nearly identical condition on a dealer lot in February 1984. The asking price was $27,500. He offered $24,800. They took it in 20 minutes. It wasn't panic. It was structure. He picked up a field cultivator at auction in April for $4,100. He watched a 4430 move through the ring at $18,200, compared to the $29,500 he'd sold its twin for 2 years earlier. He bid on a grain cart and let it go at $6,800 when it went to $7,100. He found one privately a month later for $6,400. By the end of the 1984 buying season, Ray had spent $68,000 of the $63,000 he'd cleared in March 1982, plus approximately $12,000 from operating reserves to rebuild a functional equipment line. He'd replaced 60% of what he sold at prices that averaged 38 cents on the dollar of what he'd gotten. The math on that. He had roughly the same capability he'd started with. His equipment debt was substantially lower, and he still had the farm. Dale Westerfield's 1984 was a different story. He'd been running tight on the operating note for 2 seasons and had negotiated a restructure with his lender in the spring. He kept the land, kept the major equipment, but the lender put covenants on the note that restricted his ability to take on additional cash, rent acres. He was farming smaller involuntarily, and the lender was now in the room for every major decision. He wasn't finished, but he wasn't free either. In the spring of 1985, an 80-acre parcel 2 miles south of Ray's owned ground came up for sale. The estate of an older couple, no farming heirs, priced to settle quickly. The listing was $480 per acre, about 55% of what comparable ground had brought in 1981. Ray had approximately $27,000 in his operating account and access to a $60,000 line of credit he'd barely touched in 3 years. He bought the ground, not all cash. He carried a 20-year note at 11.5%, which was a rate that in 1979 would have looked like a bargain and in 1981 would have looked like a gift. He put $18,000 down and financed the rest. The payment was $487 per month, on 80 acres of corn ground yielding 130 bushels at $2.40. His gross was around $24,900 per year. After all costs, seed, chemicals, fertilizer, custom work, land taxes, and the note payment. He cleared roughly $6,200 on that ground in the first year. Not spectacular, but he owned it. And unlike rented acres, it didn't disappear if the landlord decided to take a better offer. It was a permanent piece of the cost structure going in the right direction. The bank that financed the land purchase was Commerce Federal, the same institution where Ray had held his operating note for 11 years. The loan officer was a man named Gerald Ashby, who had been at Commerce Federal since 1971 and who had spent the last 3 years watching the farm economy with the particular expression of a man who has learned to separate farmers who are in trouble from farmers who have managed trouble. Gerald approved the land note in 2 weeks. Then, 6 months later, he called Ray in for a meeting. The meeting wasn't adversarial. That's worth saying clearly, because these bank meetings in 1985 were often adversarial. Farmers coming in hat in hand, lenders going through the restructure playbook, everyone uncomfortable. This meeting was different. Gerald Ashby had a folder in front of him with Ray's account history. He'd pulled 3 years of statements. He'd looked at the equipment transaction history. He pushed the folder to the side when Ray sat down and said, "I want to understand what you were thinking in 1982 when you ran that auction." Ray told him. The dealer lots, the repo uptick, the overcapacity, the fixed costs, the legal pad math. Gerald was quiet for a moment. Then he said, "You know what your debt-to-asset ratio is right now?" Ray said he thought it was somewhere around 28%. Gerald said it was 24%, and that the regional average for farms of comparable size at that moment in the spring of 1985 was 61%. "I have farmers in this county," Gerald said carefully, "who are coming in here asking me to extend notes that can't be serviced at current commodity prices. I have equipment that we've taken back that I can't sell. I have land in our portfolio that is worth 40% less than the collateral value when we made the loan." He paused. "And I have you, who sold equipment voluntarily in 1982 at full market, bought it back at 40 cents on the dollar, purchased additional ground at depression prices, and is sitting here with a 24% leverage ratio." He didn't say what Ray had done was smart. He didn't frame it as exceptional. He said, matter-of-factly, "We'd like to offer you access to an expanded operating facility, and if additional land comes to us through estate or distress situations before it hits the open market, I'd like your number to be the first one I call." Ray said that would be fine. He drove home on County Blacktop in the late afternoon and thought about the 60 people who'd stood in his yard in March 1982 and concluded he was finished. He didn't think about it with satisfaction exactly. More like the quiet acknowledgement that structure, followed over time, resolves into clarity. You don't get to skip the middle part. The doubt, the whisper, the neighbors who pass your yard and see the empty space where the combine used to sit. You have to go through it. It wasn't panic. It was structure. By 1986, Dale Westerfield had sold 320 of his rented acres back to the landlords, not by choice, but because the landlords needed better tenants with cleaner balance sheets. His equipment line was intact, but his flexibility was gone. His lender sat in on his cash rent negotiations. He was farming, but not freely. The auction yards in the region ran through the 85 and 86 seasons at a volume that exceeded anything the auctioneers had seen in their careers. The county extension office published a report in late 1985 that estimated 14% of the farms in the region would change hands or cease operation within 3 years. The equipment flowing through auction rings had depressed used values to the point where dealers were turning away trade-ins they couldn't afford to carry on their lots. Ray's yard, by contrast, had most of the equipment he needed and minimal debt attached to it. The 8430 he'd bought back in February 1984 for $24,800 was in the shed. The field cultivator he'd picked up for $40,100 was in the shed. He was farming 960 acres now. His original 320 owned ground, the 80 he'd bought in 1985, and 560 acres of cash rent that he'd been able to bid conservatively on because he wasn't stretched on fixed costs. The operation looked, from the road, smaller than Dale's had at its peak. Less iron, less expansion, less noise. The balance sheet looked entirely different. Gerald Ashby called in October 1986 about a 160-acre parcel. Estate situation, heirs not farming, price to settle the estate within 90 days, $390 per acre. About half of what it had sold for in 1980. Ray made an offer the next morning. Here's what this story is actually about. Because it isn't about one farmer or one equipment auction or one county in the Midwest. Between 1981 and 1987, approximately 235,000 American farms went through foreclosure, forced sale, or significant financial restructuring. Farmland in Iowa lost an average of 63% of its value. Equipment values across the Corn Belt fell 40 to 50% from 1981 peaks. Dozens of agricultural lenders failed. The farm credit system required a federal bailout. Entire rural communities were restructured around a smaller agricultural base. Every farmer who went through that period could see the same dealer lots Ray was looking at in 1981. Every farmer could track interest rates. Every farmer understood, at some level, that grain prices had softened and that the margins that had made the expansion of the 1970s look inevitable were no longer there. What separated the ones who came through from the ones who didn't wasn't information. It was what they were willing to do with it. Shrinking voluntarily in an agricultural culture that reads yard equipment as status and expansion as virtue requires a specific kind of discipline, not heroism. Discipline. The willingness to accept the social cost of looking like you're in trouble in order to structurally avoid actually being in trouble. To sell equipment you might want back. To walk away from acres that feel like momentum. To hold cash when everyone around you is holding iron. Liquidity decides. Not at the moment when things are going well, at the moment when they aren't. Ray Decker farmed until 1994, when he sold the operation to his son-in-law and moved to a smaller house on the north edge of the property. The 400 acres he'd accumulated through the 1980s, bought at distress prices when the structure said to buy, were worth substantially more by then. His equipment was mostly paid off. His credit relationship with Commerce Federal was, in Gerald Ashby's words, one of the cleanest farm files we carry. He hadn't leveraged into the 70s expansion at full speed. He hadn't held everything through the correction, because he'd been told to. He'd looked at the structure of his own operation and made the call before the structure made it for him. That's the difference between managing a downturn and surviving one. Would you have held on in 1982? Would you have watched the auction bidders drive away with your equipment and trusted the numbers over the comfort of a full yard? When does shrinking stop being failure and start being strategy? Leave your answer in the comments. And if you know someone who made a hard call early, who sold before the crash, who cut before they had to, share this with them. These are the decisions that don't get talked about. They're not dramatic. They don't look like much from the road, but they're the reason some farms are still standing.